Welcome back to Happy Investors, this time with 5 top stocks to investigate for April 2024. Possibly really good buying opportunities, or otherwise to keep following. There are, in fact, 2 scenarios regarding the American market. First of all, the best case scenario, the stock market is going to drop significantly. Often, after a significant drop, there is a short-term rally, and then the market declines further. It could be that we are currently in that short-term rally. Only yes, you can never be completely sure. So to completely avoid market timing, I would say it's best to look at individual cases. In other words, can I buy a company now at a favorable valuation, which in the future, especially in the long term, can also realize good profits? If that is the case, then all major declines of 30 to 50% form great buying opportunities. And some of these stocks seem to have long-term potential. Of course, it's always good to approach and investigate whether this is actually the case. Additionally, the second scenario is yes, the market that is not in a temporary upswing but continues to rise. I think this scenario is really the case. These are really good stocks to investigate with potentially strong growth potential because they have all declined significantly. And if hope returns, then these stocks will receive a higher valuation again, higher than at least today. And this decline of about 50% for some stocks can lead to higher returns in the long term. Please note, these stocks are primarily selected based on factor analysis. That means we look at a number of factors, a combination of which statistically appears very impressive for the next 6 to 12 months. I myself also look at the long term, of course. Some of these stocks I have been following for a longer time, some even for a year and a half. I really haven't bought them yet, missing out on large returns. Just always try to stay within your circle of competence. And if you have doubts, it's better not to buy. And now I am someone who already invests a lot in risky growth stocks, where I sometimes step out of my comfort zone into sectors where I don't have a lot of expertise. Regardless of how much knowledge you acquire, you still run the risk. So, of course, you can also experience significant declines because of that. But also remember, when you look at your own portfolio now and you think, hey, I do have quite a few stocks that are down, no worries for the long-term investing. At least minimizes risks and mistakes. Because if you just invest in good companies that rise in the long term, then you only need a few winners to actually make the entire portfolio good and achieve high returns. Of these 5 stocks, there are a few that I would find interesting enough to mention. Let's take a closer look. The first stock that might be interesting as a top stock for the next 6 to 12 months is Nextracker. This stock is a company that is involved in sustainable energy, and they make all kinds of products, but they are best known for solar trackers. They also have software for solar panels, and they have a segment that you see under foundations. That is the engineering of projects for very large solar panels installations. Then you might think, yes, sustainability is not really something for the short-term trend, especially with Mr. Trump at the helm. So that is also a concern I would have. Personally, I do not invest in it. However, we do know that Nextracker has a 30% market share, and it has a potentially very interesting situation based on the stock itself, and you will see that in the coming minutes. First of all, it's interesting to know that analysts, i.e. from Wall Screener, and there are quite a few, think that it is quite a big buying opportunity with an upside potential of about 24%. I am really a Morningstar that focuses mainly on intrinsic values. They give the fair value SME of only $31 compared to the current price of $45. So it is rated significantly lower, hence it gives 2 stars. The price earnings is estimated at about 12 to 13 for next year, 13. And that can therefore lead to a price increase. Why? Because if the EPS development, which is indeed estimated for next year at about minus 0.5%, but possibly in the following year can grow by about 7 to 8%, and the price Morningstar that rises, for example, in the short term to about 20 or to 15, that is in any case higher than the current valuation. Therefore, it already has a price to earnings of 15. In the short term, an upside potential of about 18% on average per year, or a total of 40% over the next 2 years. So that valuation is attractive. A new software that we have, recently Market Screener, then the Pro Edition. It costs something like $3,000 per year. We have also added it to our stock analyses at Happy Investors. These are still available for €99 per year, where we select a top stock every month with extensive research, especially fundamental, management, competitive position, market, long-term growth, those kinds of things. And we still offer it for €99 per year. And also every month we provide an update of all screeners that we use with an overlap between top stocks, purely transformation and inspiration for further research. So yes, the cost we currently spend on all these screeners are about 10,000. That is the word of the company. Because we are getting more and more members, we can make more profit and keep the price low. Everyone benefits from that, including us, of course. So that's a win-win, as you call it. Market screener is quite interesting. And what we see for this stock next, Raka, is that the investors give a 5-star rating. Also a 5-star rating from the trader. But I'm not going to focus too much on that myself. But ISG is an A score. Not too surprising. And you see a number of profiles here that exist. The tool is very comprehensive. I will show more elements of it in other videos later. But what I find important for the video analysis is to show at least the summary. And they also confirm that the company has strong fundamentals. Very good. And it's mainly about the mix. So the factor, and we will see that reflected in the factor analysis. The mix, what makes it potentially interesting? Stock. Although there might be less growth potential in the short term, for the long term, it can still be relevant because solar energy is still sustainability. However, the question naturally arises as to how profitable all these sustainability projects really are. But that is a more fundamental question. And if you are skeptical about that, you definitely should not invest in solar panels. But that's beside the point. Potential for earnings per share might be limited. We have also seen that here in this forecast. But nevertheless, because the return profile is interesting enough, it can still rise. Why? The price of earnings is currently around 12.5. But for next year, given the strong growth, it is estimated at 13.7 according to this model. Only other metrics, such as price to cash flow or EV to EBITDA, are all still relatively cheap compared to the sector median. This means it is undervalued compared to the sector median. But the question is, of course, what is the intrinsic value for the long term? In the short term, there will be a dip. For the long term, the other question is, we look at that market value. It is about 6.5 billion. They have only recently been on the stock market, and the total amount of debt is low. That is very favorable, of course, and they have a fairly large cash position. So the financial health is sound. Now we have a section about growth. Outlook, and this does not align with the price to earnings for next year. So further investigation is needed here because it seems like the forecast for example, EBIT growth is very interesting. And that is quite remarkable. That's why it also gets a strong buy based on the factor under the radar because valuation, growth, profitability, all are very strong. I find the profitability particularly interesting. Net margin has increased to about 20%, while the 5-year average was only 9.7%. But also, for example, the return on assets is currently 18%. Why do we look at return on assets? Well, they sell assets. It's as simple as that. So you like to look at total assets. If you have, for example, a software company, then you don't really look at total assets, but for example, at total capital and at return on equity. But very often there is, of course, a balance between these figures. If the return on assets is high, for example, the return on total capital is usually high as well. That simply means, in simple terms, that they generate a high return on the products they sell. So that's good. In the very short term, Zexrank gives a buy signal for this stock. Their own price target is 50 in the short term. What we might want to see is, if we're lucky, the stock drops in the short term to a price level of, for example, 31. Then that could be an interesting entry point because a support level might form there. Why would you want to look at that? Because there are simply many people who trade based on technical analysis, and then we can use the short term to our advantage for a long term position. Incidentally, that price of 31 corresponds with the Morningstar fair value estimate. But because the current valuation is already relatively cheaper and the price drops in the short term, 31, then you have a bargain. Stock. The question remains, of course, what is the long-term growth potential in terms of at least? Will they generate more free cash flow in the long term? Yes. Yes. Or no, that is the crucial question. Apploving is currently again a top stock for possibly the short term and maybe a bit longer term. Apploving has been mentioned before on our channel. I have had a position myself and still do in Apploving, as we see here. But the position has recently been significantly downsized after still about 4,000 in value. The total profit and gain stands at plus 23,000. And You see the return, 560%, but it was above 1000%. However, I have sold quite a lot, which I also shared in the monthly portfolio updates. Do you want to stay informed about that? Subscribe to our channel. Every month we provide an update on our portfolios, and I'll show it to you. I always like to show the evidence. We first bought a Ploving Shakespeare in early January. That was still at a price of $38, very low. And then we bought this winner again in March at a price of $62. Why? Because initially, when I bought the company, it wasn't very certain yet whether they would grow inclusively, and you also need to have some luck with that. But indeed, it turned out that they were going to grow explosively, and therefore I bought more after the quarterly figures. Yes, since then it has exploded, and I have sold a lot. Initially around the price level of $460, and then sold more at $442, and the stock is still below this price. And I don't really think it's worth buying at the moment. By the way, just a quick note about that portfolio update. I've also recently taken a new position in an ETF, uranium ETF. Very recently, and in the new update, I will explain why. But here we are going to talk about Ploving. Ploving has been previously mentioned by us. It is a software company, but what they actually mean is simply translated into you have a mobile app. If you start playing games on your app, advertisements will eventually appear. And Ploving ensures that those advertisements are displayed. So I am a company, I sign up, I want advertisements on mobile gaming, and Ploving ensures that this is realized. Why are they growing so quickly? And they are also extremely profitable because they apparently generate very good results for their companies. There are also a number of interesting cases to be found online from companies that have joined Ploving and achieved enormous returns on their advertising budget. Super interesting. The analysts, in this case 26, think that significant price momentum is possible. With a price target of 35, it means plus 60%. And there are also analysts who estimate it as low. A price target of 200 means minus 40%. So you see a huge difference between high and low. That simply means uncertainty. The only problem with Ploving is if this growth, in this case of EPS, is not realized, and this growth is still very high. By the way, let's take a step back. The market value of this company has now risen to 100 billion. When I took my first position, it was 15 billion, and the company is now worth 100 billion. I find 100 billion to be really quite significantly large, and that's why I sold a substantial part. First of all, to take profits, because I think the stock is overvalued, but I am not buying more after this significant drop, for the reason that it is still a large company, and people might expect interesting growth potential, and I could be wrong, but I prefer to think. I have turned my money into cash, and I am waiting for better opportunities to buy certain stocks with a smaller market value. I focus more on small caps because you can capture more explosive price changes with them. It also carries a much higher risk, so you need to diversify a bit more. And you see it now. My portfolio also includes companies like Advice Lab Solutions, min 70%. So, yes, significant losses do happen sometimes, but you only need a few winners to make up for it all. And the problem with Ploving is that its current valuation is still somewhat on the high side, even though it is a great company. But it also needs to seriously, achieve growth. And we're talking about profit growth to justify this current valuation, at least for the coming years. From Market Screener, we see a number of interesting highlights and also weaknesses. You can pause the video if you want to read all of this. The investors give it 4.5 stars. That is quite high, actually. Financials look very good, especially, of course, sales growth, but also profitability. That is very high. But Adam, he is the founder. That is one of the reasons why I also invested. I like to invest in companies where the founder is still at the helm, preferably as CEO. And the number of shares, because the company has grown so quickly. Also, because Adam sold a lot of his shares. Does he still have 2.6% insider ownership? And that translates to about 2.6 billion. So that's quite a lot of money. The story is actually you should mainly buy when it wasn't. Stock is, or in other words, a popular share. And that's why it has become less interesting for me. But the Ploving has dropped a lot in the short term, and that can also lead to a strong recovery in the short term. If you look at that valuation, we see high price to earnings, but the growth can also be high, with an emphasis on can. So, if the growth disappoints, this valuation suddenly becomes super high. Is it justified? Then you have a PEG ratio that is below 1, and that is much cheaper than the sector. Median, and below 1 is often a sign of being undervalued, with the emphasis that a huge growth potential is expected here. And expectations are often not met if they are too high. Total debt and cash are currently favorable. I still remember when I bought Oplovin, it had a lot of debt compared to the cash position and market value, but the growth has been realized, so it's no longer an issue. The growth looks impressive. The profitability is also very interesting. EBITDA margin of 50% is unprecedented. It has increased significantly in a very short time. Net margin, it was unprecedented back then. I was still buying in 2023. Negative, and now 33% net profit margin. Really bizarre. High return on equity, high return on capital. Super interesting in terms of profitability. And yes, that's why it is quite an interesting profile. Zex Schenk gives a strong buy recommendation in the short term. And we see a price target from Zex. Schenk is also a bit higher than the current price, but not as high as some analysts have led us to believe earlier. There. The average price target is much higher than that of Zex. After a massive price increase, it plummeted by almost 50%, actually a bit more if you look at it on a daily basis. However, what I want to show is that growth stocks can drop significantly in the short term, especially if the potential is not realized. And Oplovin has previously dropped by almost 90%. And that can easily go against you. Inflation is increasing, costs are rising. You hear everyone around you saying, yes, everything is getting a bit more expensive, and the interest rates are not dropping, or not really very great. Prospects for good stocks. And also Trump, who is doing all sorts of strange things, so it can also just go the wrong way. Take hold. That's why I'm not so convinced that the recent drop in Oplovin is a huge buy. But I could be completely wrong. I still have a small position. I'm holding on to it. That's my opinion. And yes, personally, I keep waiting for it to happen. The profit has already been cashed. So I'm naturally looking at other interesting growth stocks with much smaller market values because they can grow more exclusively. Stock EAT from Brinker International is a stock that has been for a long time. Considered a top stock based on the factor analysis of Seeking Alpha. This is a franchise concept. They have multiple concepts, including Little Italy, and I know the company because I had my second date with my girlfriend, my very first girlfriend, and maybe also my last, I hope. We have been together for more than 10 years. That date was 10 years ago. And back then we also went to eat pizza at Little Italy. Everything about the date was perfect except for the pizza I had at Little Italy. But well, those are my personal opinions from experiences 10 years ago. So I hope the pizzas have gotten better since then. And the stock is certainly much better than before. It is an interesting stock to further investigate. I personally think that the growth potential might be limited in the short term, but there are some interesting core characteristics. The analysts, in this case 20, give a price target of 180, still a 26% upside potential. Interesting to see that the lowest price is still above the current price. For example, Morningstar thinks differently, 2-star rating, fair value estimate of 95. If we look at the historical valuation, we see that it might be overvalued, but let's zoom in on, for example, a 7-year time frame. Then it is actually below the intrinsic value. What is the difference between the first and the second chart? That is the normal multiple that is used, because the multiple, and which values has been around 13.6 over the past 5 years, was about 15 over the past 20 years. And the model also naturally considers, for example, forecasting in relation to growth. What we see below on the screen, that is the growth. Earnings per share. That, of course, needs to increase. Preferably also look at free cash flow, especially if you want to focus more on the industrial value. But the current price-earnings ratio is around 20 due to the recent price drop. And yes, the organizers assume that the stock can still increase more. And as a result, you actually get a price Morningstar estimate equal to 20. That means an upside potential of about 18% on average per year. And that is quite seriously high. However, I personally assume somewhat lower estimates and would choose a lower multiple. And then you see that the growth potential might indeed be limited for the next 3 years. With an average return of about 1%, adjusted for high inflation, you incur a loss. So personally, I find it less interesting. If only I had bought earlier. But yes, that's always the case. If only I had done this, or if only I had done that. The reality is it's not like that. And at the moment, investors from Market Screener also give it a 2-star rating, so they are not super enthusiastic either. Yet on factor analysis, it is still a strong buy, and the first time I came across the stock was through Alpha, from Seeking Alpha. Quite interesting, but they are mainly selected based on momentum. And if the momentum is against you, it can be quite disappointing. Yet, according to their analysis, the risk ratio is still, I estimate, around 0.46, which is super low. Well, below 1. This is related to the good prospects we see here. But also, for example, profitability has increased somewhat. Profit margin has risen a bit. Return on total capital is currently high, but over a 5-year average, it is not that high. Therefore, I don't really think it's a very strong quality stock. And especially that short-term momentum was just great. Possibly not anymore, though. Still, Sergius Genk also indicates strong buy. According to their price target they use, for the next 6 to 12 months, it is slightly higher than the current price. Are we looking at practice? Analysis. The only thing we see is that an all-time high has been set, which is significantly higher than the previous all-time high. But we'll look closely at the rises and falls. It has once dropped by about 70%. And what I want to show you is when the momentum decreases and the current valuation is high and the profit growth disappoints, which could very well happen, then you get an example like Albert Combry and Fitch with the ticker ANF. It also scored very high for a long time on the factor analysis that I am showing here. But if things go wrong, it can turn out very badly. And ANF, for example, from the last peak, it drops by about minus 60%, and given the decline, it might continue further. This is not the first time this has happened. Look here, for example, at the financial crisis, but also in 2011, it dropped significantly. So I'd be very careful with where you invest. I think there are better stocks than Brinker International, but I'm showing it to you anyway because it does have some interesting characteristics. And personally, I'm not an expert in this industry. Are you? Experienced in restaurants and franchises and that sort of thing? Then you have an edge, and I'd love to hear from you what you think of this stock. The first 3 top stocks were all related to growth, but perhaps growth is not really the best area to invest in at this time. Also considering the interest rates and such, and maybe we should switch to value stocks. Depends on your strategy, of course. Sticking to a strategy is, I think, better in the long term than switching. But there are quite a few arguments for switching to value investing. Well, Barclays is a potential top stock when it comes to value, and Barclays is, of course, a bank. I don't invest in it myself. I don't invest in banks. However, the characteristics are such. Interesting that I show you. Purely for inspiration also, because we have tools that you might not have and you might appreciate that. Analysts indicate that it is a buy, according to them, with a price target of about plus 5%. Morningstar indicates that their fair value estimate is slightly lower than the current price. But there might be something to say because the momentum is strong and there could be further upside potential, also based on historical trends and charts. But that is, of course, secondary. Focus mainly on the intrinsic values of the company. If we look at the forecasting and the historical valuation, then the stock seems to be undervalued. Of course, based on expectations that people have, which are also related to growth, looking over a period of 7 years. So the latest forecast, we actually see a bit of upside potential, actually quite high. The normal multiple's currently around 6.4, but in the past it was higher. For example, around 9. And for a large bank like Barclays, that doesn't seem very high. Let's be a bit more cautious and take 8.6. We see the EPS growth estimates from analysts, and there are quite a lot of them, and they expect this bank to grow over the next 3 years. Well, anything can happen, as you know. Financial crisis, interest rates that might drop. You know it all. So it's purely forecasting. It's purely transparency. It's not a conclusion. Be aware of that. It's not reality. Anything can happen. But what is the potential, just to show you for inspiration and because it's interesting? Well, with a lower price to earnings ratio that seems to be relatively on the cheaper side, could it be that the average return is above 20% per year? And that for a boring bank like Barclays. So that's what they call possibly a value play. Looking at a number of other characteristics, we mainly see just the financials there, intrinsically. look interesting with valuation, but also that there is strong consensus that the company will grow in the short term. And I'm talking about earnings growth. Factor analysis indicates a strong buy, especially the combination of valuation, growth, profitability, and momentum. That is starting to increase. That valuation seems very low. For next year, the estimated earnings are 7, but it's important to look at the payout ratio. That is well below 1, which is positive. Of course, always look at the balance sheet and debts. That is crucial for a company like Barclays. But again, I have no expertise in banks. That is all too complex. Even if you investigate for hours, you still won't know for sure. Certainly. So you really need to be an insider to understand how the bank truly stands. So there are always surprises lurking around the corner. The EBIT margin is estimated to increase by 14% next year. The current net margin is quite high. The 5-year net margin is also high. Schenck indicates a buy signal. Their price target is around $18, significantly higher than the current price. And if you look at the reason why now, it's mainly due to the momentum. You see a huge price increase based on good news, and the profit increases plus 100% have already raised the stock. Looking at the historical development, some people now only look at these kinds of charts and see, hey, this stock is hot. Strong momentum might realize more profit growth again is already reasonably cheap and might even rise back to an all-time high. Who can say? Then it's another plus 30%, or maybe, for example, to, I don't know, 2,000 plus 100%. But yeah, looking at charts doesn't change much. Focus mainly on the fundamentals and on the profit growth developments. And if the analysts' estimates are correct, Barclays might rise significantly in the coming year. Finally, the last top stock, which has also been scoring high on factor analysis for a long time, is SkyWest. This stock is a company, holdings company, focused on airlines, and I am personally not interested in this sector. Followed this company for a long time, never bought it myself, increased a lot, recently dropped a lot, possibly a second entry point, worthy, but quite difficult, I think, and I just don't find the business model interesting enough. But that's a personal matter. I'm showing it to you because it's interesting enough for further investigation. And possibly you have more knowledge about this sector than I do. The current price of 91 is considered low by analysts because they estimate that the stock can rise by 40%. The lowest estimate is still a plus 8%. Let's hope they are right. The fair value estimate by Knight Morningstar Star is estimated lower, and they do indicate almost economic moat. Now, regarding the historical valuation, there seems to be enormous growth potential. The stock has already risen a lot in a short time. Click a bit more in the zoom on the timeline. Then we see that the price is significantly below the industry value. Forecast with an emphasis on prognosis and forecast. Note that normally the multiple is very low, 12. And based on, for example, the last 10 years, it is somewhat higher. But we assume this 12. A price to earnings ratio of 12 is quite low. And we see EPS estimates that may or may not be accurate. And we also see only 2 analysts providing an estimate here. So that's no longer the case. Very reliable. The average return can be about 18% per year. It can also be higher with a higher multiple. For example, around 30% on average per year. That is very high. But let's take, for example, 2026. That we have a different estimate there for more analysts. And the normal multiple for the holder of 12 can still have an upside potential of 15% on average per year. All in all, it seems like an interesting profile. Look, for example, at weightings from Market Screener. Investors indicate a or 3-5. However, 5 stars for traders. Especially the profile, because a bit of valuation might still be interesting. We also see that in the factor analysis. Price to Morningstar for next year is estimated at 10. The PEC ratio, however, at 1.1. So above 1, that is not very favorable. However, a lower price to cash flow. The question is more that I would look at the model here. Is the company interesting enough in terms of its revenue model? The good estimates are very high in these screenings. Yes, I wonder what is really the case. Companies, therefore, do not know this well enough. Also, the profitability is not super interesting if you ask me. And if you look at the very short term, the estimates are positive. Strong buy from Zexrank. Analysts also think it will rise. Price target of 111 at Zexrank. The question then is only in the very long term. You see that there isn't really a super long stability. Rising lines are present. What you do see with quality companies, they always have a long rise, of course, with significant short-term declines. But that's a different chart than what we see here. Why is that the difference? Because SkyWest most likely does not have a strong competitive advantage. And for example, a Morningstar Holdings, an Alpha, or an Amazon, they do rise significantly in the long term because they simply have a competitive advantage. And that is the difference between investing in high quality businesses, which often have a higher valuation, versus less strong companies like SkyWest. And the question is, can this company transform itself into a better business model? Yes or no? The sector is not particularly interesting in this case, but that is a personal opinion. What do you think of these stocks? Top stocks for this month. Let me know, especially if you have insights and experience with these companies. That helps me, but also other readers. I'm curious about it. Thanks for watching and see you next time.